It's time for the Money Puzzle Podcast. With good conversations and realistic solutions to the money puzzles we all face every day. I'm your host, financial advisor, chartered financial consultant, and president of Edgen Insurance and Financial, Robert Edgen. Now let's get this show started. Hi there, hello, and welcome to the Money Puzzle Podcast. I am Robert Edgen, and as always, I'll be your guide for the ride for the next few minutes. Each week, we look at a different piece of the money puzzle and practical ways to solve it so you can have the financial confidence you deserve and the future that you dream of. This is episode number 21, which is crazy and hard to believe. But today we are continuing on with the month-long look at long-term care, and today's focus is on self-paying options. So we started a few weeks ago with some facts and figures about long-term care. Today we're talking about how you actually pay for long-term care. To help me out, I've got my amigo, my pal, my business buddy from another mummy, Brian Johnson in studio. Thank you for coming down from Denver. And
good morning, everybody.
Yep,
absolutely. My pleasure.
Fantastic to have you here. It is. I'm wearing my Bronco shirt because when we're filming this, it's the day after the preseason opener. You don't even have a TV, so you probably didn't notice.
I have a TV. I just don't have cable or anything like that.
You just don't care about
I just
TV.
don't care.
All right, well, I watched last night. The Broncos lost, but it doesn't matter. It's practice. It's just, no. We're in Colorado.
Okay.
Anyways, today we're talking about long-term care, self-pay options. So in case you're thinking about, just writing checks for your long-term care if you ever need it, that's kind of what we're going to go through. But Brian, we're going to go over some other self-pay options as well, correct?
Yeah, reverse mortgages is one that we can talk about. Bridge loans is another one that we can talk about. And one that a lot of people hate talking about, life settlement options. I think
life settlements. That's right.
Some people are maybe hearing the advertisements on the radio about it, but it needs to be talked about.
We will talk about all those things. I'm excited to get into that conversation, but before we do, I do a lot of reading and research, and I come across different headlines and news articles. So I thought we would take a minute to look at some news.
Crazy.
All right, today's news article comes from Reuters, and the headline reads, Swiss government says coffee not essential and stockpiling to come to an end. So Switzerland on Wednesday announced plans to abolish the nation's emergency stockpile of coffee in place for decades after declaring the beans not vital for human survival. So first of all, I want to know, what the hell is wrong with Switzerland?
Well, hey, it's true. It is vital. But you know what? I am happy to hear they're not going to do it, because what does that mean?
It means prices should go down.
Yes.
So that is true. But you know what? Switzerland is wrong. I just did a 20-mile backpacking trip, and I found a way to pack 3 cups of coffee a day for 4 days, just to make sure that I did not go a single day without coffee.
For all you people who live in Colorado, if you want to do a great trip like that, Refrigerator Gulch in Lost Creek is amazing. I did not go on it. My family and I did it a year ago. It's fantastic.
It was awesome. But you know what I had? 3 cups every day.
Coffee. Oh, yeah.
Every single day. It's not vital.
We do the same thing. Even my kids drink it. It's vital.
It's important. It helps you grow.
It does.
It does. So here's what they say. The system of emergency reserves for coffee was established between World War I and World War II as Switzerland prepared for any potential shortages in case of war, natural disasters, epidemics. Switzerland's mandatory coffee reserves are now spread over 15 companies. Wow. Nestle and other ones. It amounts to about 15,300 tons of coffee, enough to cover 3 months of usage for the Alpine states' domestic consumption.
3 months. That's great.
15,000 tons. So coffee stockpiling obligations, though, are expiring at the end of 2022, with companies free to draw down what they store in warehouses. I think it's sad.
I think it's great. That means more people are going to have more access to more coffee.
All right. I look at it as I'm going to start stockpiling my own coffee.
I do.
Just to make sure. Really?
Yeah.
How much coffee do you have stockpiled?
I don't know. A pound. Not much.
That's good for this week. So.
It is. I don't know what I would do, man. My head would explode.
No, I get it. All right. That's it for this week's news. If you want to read the rest of that article, which is actually pretty interesting, we've got the link in the show notes. You can access it there. But for now, let's get to today's hot topic. All right, so today we're talking about different ways to pay for long-term care, and we're going to break this into a couple of different episodes, starting with the self-pay options.
Sure.
Okay. Self-pay options really include self-pay, which is just writing a check as you go.
Write checks.
Or reverse mortgages and life settlements.
Sure.
So there are 3 other ways to pay. We're going to talk about those next week, and that gets into some government programs and insurance, things like that. But one of the areas I thought we should just touch on has to do with Medicare, because Medicare, a lot of times people get confused and they think that they're covered for long-term care under Medicare, when in reality, Medicare does not cover long-term care costs.
They don't. Well, what they do is very tiny. You have to meet some strict guidelines before they actually do it.
Yeah, so what they cover is rehabilitation, recovery. So with your Medicare policy, if you spent 3 days as an inpatient in a hospital,
right,
then you can get some assistance for recovery care in a nursing home or skilled nursing facility.
So let me ask you, Rob.
Yeah.
You may know. So if you had, say, a heart attack and you got sent to a rehab place, is that rehab stay eligible for the hospital stay?
I don't even say that again. I'm not sure I understand the question.
So like a lot of people go into cardiac rehab, right? Especially depending on age. So you go from the hospital through your major recovery in the ICU and all that stuff, and then some people actually go on to a separate rehab place. Right. Would that be a part of that 3-day rule?
No, it's got to be inpatient in the hospital, but then the cardiac rehab would be part of the Medicare skilled nursing rehabilitation or recovery. So the way that Medicare does it, for the first 20 days, they cover 100% of the costs. Right? As long as you are recovering.
You're improving.
You are improving.
Right.
If you quit improving, what do?
They boot you.
They kick you out. That's right. But if you are still improving and recovering after 20 days, then days 21 through 100 have a deductible.
They do.
A daily deductible of $170.50.
We should just make it 51 cents. I don't know.
If it was up to me, it'd be 170.75.
Okay.
Yeah, but it's not. So it's $170.50. So that means for a 100-day stay, if you were there the whole time, you didn't get booted, you were still recovering, it would cost you $13,640. Okay.
That is one heck of a stay.
So that's one heck of a stay. But what happens at day 101?
It is all you.
It is all
every single dollar at that point. So if you were in a facility that was $200 a day, it's all yours.
You're paying $200 a day.
That's right.
So, Medicare can and does help for short-term things as long as you had that 3-day stay as inpatient in hospital.
Right.
And then you go on for some skilled recovery care after that. But it does not actually cover long-term care, which gets us back to the 3 ways of paying that we're going to talk about today and the 3 ways we'll talk about next week.
Okay. Let's do it.
All right. So the goal really when we talk with clients is to figure out, which of the 6 ways or today's 3 ways work best for your goals and your resources. That way you can live where you want to live, do what you want to do for as long as possible,
right.
When you are needing care.
Right.
So, all right. So let's talk about self-pay. Now, for starters, if you are going to handle self-pay yourself, well, let me tell you just a real quick story about a couple that I met with not too long ago. We had done an event about long-term care planning, and then they came in, they were visiting with me. They had $2 million in the bank. So they said, hey, we know that care costs about $100,000 per year.
Right.
So that would give us 20 years or 10 years each. So we're just going to take the self-pay option.
Sure.
Right. So, okay, that's fine. So if you're going to do that, first off, Brian, kind of how much should they think about setting aside or preparing for long-term care?
Oh, man. So if you look at some of the actual averages per person for 3 years, so they said both of them, they would fund themselves, right? For 2 people.
That was their plan.
Their plan. You're looking at anywhere from $600,000 to $700,000 over a 3-year period for both of them.
Yeah. So if we do the math, the average here in Colorado Springs, where we are,
right,
not where you're at, but here it's $105,000. Up near you, I think it's a little bit more expensive.
109, I think.
Okay,
109,000.
So $105,000 per year times 3 years, which is the average stay.
Yep.
That's $315,000. But if you are married and there are two of you and you want to make sure that you're prepared for two, $315,000 times two, $630,000.
Crazy.
Okay? But that's today.
That's today, yeah. So in 3 years, because was it going up by 6% a year?
In 2018, it was about 6.67. In 2017, it was 5.5.
So 6%.
Call it 6%. Well, yeah. I actually, we looked at the Genworth cost of care study, which I've got a link. Right. We'll have a link to that in the show notes. And 10 years down the road, the average cost of care here in Colorado Springs, instead of $105,000, is expected to be $141,000. Okay, so now you take that. The question isn't how much you should set aside, or that is the question. But the second question is, set aside for when? When will you need it?
Yeah, when? We have no idea, because you may never.
You may never need it. But if you do, then, if it's 10 years from now, let's say, and the cost of care is now $141,000, now you take $141,000 times 3 years.
Yeah.
You get, about $425,000. You want to do it times two people, you got $850,000.
Right, and that brings up a lot of questions. Is the when question. So on my way to Colorado Springs today, one of my clients called, and her mother just died. She had prepared over the last 6 months, moving her mom, and now this is from Colorado to Texas, moving her into a long-term care facility. She was in there. She was down there last week. The day that she left, her mom died when she was on the airplane.
Oh, that's sad.
I know. And so, you don't really know how long that you're going to be in long-term care, if you're ever going to need it, because you may die beforehand, or you may be there for that 14%, that's 10 years.
Well, 14% need it for more than 5 years.
More than 5.
More than 5. But 22% need it for 3 to 5.
Yeah.
So that means a third of everyone needs it for more than 3 years.
Yeah. My mother-in-law, which if you guys go back and watch the last
week's episode, yeah.
She was 3 years in assisted. Was it? Yeah, 3 years assisted, lived with us for 3 years, and she died in a nursing home after a couple of months.
So, yeah, so she had 6 years total.
6 years total.
Yeah, she was in that 14% of more than 5. And that's one of the things to think about when you're self-paying is if you never need care, self-pay is the most effective way to go.
Yeah, why not?
Right? If you do need care, it could be the least effective way to go. Right? Because you're paying dollar for dollar.
Yeah, and it depends. Do you have any kids? Do you have any heirs you want to leave it to? If you do, like me, have 4 kids and I want to leave all my money to Rob.
Thank you.
It's the least effective way to do it.
Well, so if you are going to go the self-pay route, right? First off, some things to consider. You have got to have some pretty substantial assets.
Yes, you do.
Right? Now, here we talked about, this imaginary couple, if they need it now versus if they need it 10 years, where, possibly $850,000 for care for two people.
Huge.
Right? It's huge. So, but the good news is you don't necessarily have to just take $850,000 and set it aside, because if you're investing it should be earning some money, unless you're, burying it in a can in your backyard or putting it in your savings account, because those don't really earn any money.
Yeah, absolutely.
So if you're going to...
Except for coffee cans.
You got to buy the...
Well, you store the coffee, and then you put your money in the coffee. Yeah.
On top. Then we could stockpile coffee.
That's right. And then sell it later. Like they're doing this.
Fantastic idea. So if you're going to set it aside, the question becomes... really, how much should you set aside? Now, it's a very personal question based on your age, based on, are you married or single, based on how long you might need care. So you don't have to have dollar for dollar, but if you are going to self-pay, experts all agree you should figure out the amount you need to set aside and put it into like a separate account. Yeah,
I mean, you got to think about it with anything with retirement. What are you actually going to use that money for? And you put it, like we talked about a few weeks ago, the bucket.
That's right. So you have different buckets for different things. So the next consideration, if you're going to go the self-pay route, is, where do you keep the money? Well, for starters, you want it to keep up with inflation as much as possible.
As much as possible.
And we're not talking about the normal inflation, because the inflation in the United States last year is about 2.1, but for the long-term care it was 6.6.
Yeah.
So what can you do? You might not be able to keep up with the exact inflation of long-term care, but you need to try to get close.
You got to try to get close, and that's the tricky thing, right? Because if you think you're going to need it, then you got to be very conservative with it.
That's right.
If you're very conservative with it, I mean, the banks aren't going to pay you anything. What do you do with it? It's a great question.
It's a great question.
That's why we solve those problems.
So
we try to.
That's right. And the other part of it is, okay, I need to keep up with inflation.
Yeah.
So I want to maybe invest a little bit more aggressively. But what happens if you have a crash, 2 months before you go into long-term care?
2008, or even get more specific, from 2008, December 2018. Mm-hmm. You had a 22% fall in the market.
So that's right. If it happens right before you go into care,
they can be huge.
It can be huge.
Catastrophic, yeah.
Another question to have, or that you need a consideration if you're going to do self-pay care, is what money should you use? Should you use money in your savings account? Should you, liquidate stocks and bonds? Should you cash in your IRAs and 401ks? Right? What type of money should you use?
Sure.
I typically recommend to my clients that if you're going to go that self-pay route, and then all of a sudden you find yourself needing the care, you're better off starting by cashing in IRAs, 401ks, retirement, or what we call qualified money, which means that it has not been taxed yet. Now, why would we take out money that hasn't been taxed yet that's going to cause a taxable event when we get it for long-term care? Well, the short answer is you actually get a deduction if you spend enough money on medical expenses.
You do. It has to be a certain percentage, 7.5% of your income.
That's right. And if you're going to spend $100,000 on long-term care, there's a very good chance that's more than 7.5% of your income.
Yeah. So once you hit that 7.5%, everything over it, then you can deduct on your taxes.
That's right. So when you typically go take money out of your IRA, if you take $100,000 out of your 401k or IRA, it's like getting a paycheck for $100,000.
That's right.
But if you then get a medical, the deduction for medical expenses that removes $100,000, it's basically getting that money out of the IRA without the taxes.
Without taxes, that's correct.
So if you're going into self-pay, the question also then needs to be answered. What type of account should you use? What accounts do you have available to you? But the good news is you can access some qualified money. And there's some tax, not loopholes, but some tax rules.
Yeah, rules.
That help you get it out without the taxes.
That's absolutely right.
So, all right, let's talk about reverse mortgages. Okay. This concept is very simple with a reverse mortgage. They literally work the reverse of a regular mortgage.
Yep.
So the first thing that you have to have in order to get a reverse mortgage is equity in your house.
You have to have equity in your house and an age requirement.
That's right. You got to be 62 years old or older.
Yep, that's correct.
But if you don't have any equity in your house, there's nothing to borrow against, right? You cannot get a reverse mortgage.
Cannot.
Do you want to explain a quick how they work, or you want me to do it?
Why don't you do it? You're the best talker.
I talk so much. I'm so good.
You talk all the time.
I know.
It's great.
I can't help it. So, all right. So a normal mortgage, you start off with a big mortgage and no equity.
Right. You pay
down your mortgage and your equity goes up.
You start building that equity.
That's right. A reverse mortgage, you start off with a lot of equity and no or very low debt.
Right.
And every month they pay you.
They do. They can pay you.
Yep.
Or they can do a lump sum.
Yep.
The first year is a little different. They don't do a full lump sum in the first year. It's usually a 2-year deal to get the full lump sum out of it. But yeah, they end up paying you, and you do not have to pay that money back to them.
Yeah. So if they're going to pay you, first off, you have to qualify.
You do.
And then they're going to look at the youngest borrower's age.
Right. And there is a rule, if I remember, for the youngest borrower. You can't be marrying a sugar daddy and you're 25 years old.
Well, you still got to be 62.
Right.
So you could be 62 and your spouse could be 84.
Well, but there is a new rule though that you can be, there's a certain age gap from the 62-year-old that you can do.
Okay. So if you've got this equity in your house, basically the older you are when you take out a reverse mortgage, then the more you're going to get.
That's correct.
But the bottom line is if they're paying you, $1,000 a month, right, as a payment, or $2,000 or $4,000, then every month you lose $2,000 or $4,000 of equity in your home. Plus, they charge an interest rate just like normal loans do. Right?
They have to make money on it.
They have to make money. So that is added onto the mortgage as well. So every month, the equity you've got in your house gets smaller and smaller and smaller. Or you can do a reverse mortgage, line of credit and have it there. But the bottom line is they're paying you. This is it's a good tool that can be used for long-term care if you don't have other plans for your house.
That's correct.
Right? If you don't want to leave it to somebody else, if you don't want to sell it and move to an island, and you need money to pay for care, you might be able to get $2,000, $3,000, $4,000 a month if you've got enough equity in your house.
And that may be one of those things that you do, especially if kids live out of state. Do they really want the house given to them when it's in Colorado and they say live in Michigan or something?
Right. Do they care?
Do they care?
Now, it could get to a point, and this happens often, where if you've got a reverse mortgage for long enough and you live for a long enough time, they're making these monthly payments to you, then you don't ever make any payments.
You don't?
Right? It's a non-payment loan. So how do they get their money back?
Right. So also upon the sale of the house after you pass.
After you pass or move out.
Or move out. They cannot make you sell your house off if the equity's all been exhausted.
Mm-hmm. But they'll keep making your payments to you.
And the other side of the reverse mortgage, though, is if you had one person move into long-term care, the reverse mortgage couldn't work. If both people, or there's only one person, you have to be in that house to have a reverse mortgage. If you're not in the house, you cannot do a reverse mortgage.
Once the last person moves out,
that's correct.
Then that's right. Then they want their money. Yep. Okay. So let's say that it works fine. One spouse is in long-term care, the other spouse stays there, and then they pass away. The house gets sold. That's when the mortgage is due.
That's right.
Right. Now, a little bit of a powerful concept about reverse mortgages is they're called non-recourse loans.
Right.
So a fear of it can be, these guys were paying me $3,000 a month, right, for 10 years. Holy crap! Now I owe them $360,000, and yet my house is only worth $300,000.
Right.
A non-recourse loan means you cannot owe more than the house is worth and sold for. So even if it sells for $300,000, you don't have to come up with the other $60,000. It doesn't come out of your estate. Your heirs aren't hit up for it. You only owe, at a maximum, the value of the home when you sell the house.
Sure.
Right?
Yep.
Okay. So they can work, but the bottom line is, it works best if you don't have other expectations for the sale of that home.
Right. Well, part of that, but one of the things that we should bring up on that too, real quick, is the fact that if I need long-term care and my wife doesn't, and we reverse mortgage the house and she passes, it's over.
It's done. Well,
yeah, and then now you got to find some other way to pay for it.
Yeah, because the last person has now moved out of the house.
It can be risky. Yeah, it can actually be very risky when you think about that. So.
Yeah, but it is a tool.
It is.
Right? It's a way to access money to pay for care.
That's correct.
Another way to access money and pay for care is through life settlements.
Yep.
Okay. It's kind of like a loan against your life insurance, but not really. Technically, you're selling your life insurance policy.
You're selling your life insurance policy to an investment.
An investment company.
An investment company that would then turn around, make the premium payments. They'll give you a certain dollar amount, usually about 30% of the value of it, depending on your age and your health, right? Mm-hmm. And they will take over the payments, and then when you pass, they receive the death benefit.
Yeah, so it's a way for you to get some cash now, and then they're going to get a lot of cash later. Now, you said 30%, which actually is the average payout on a life settlement. So, as an example, if you've got a whole life policy, because you typically have to have a permanent life insurance policy.
Typically, there are some that will do term, but the payout's much less.
And only if they are expecting you to pass away.
Yeah, that's right.
During the term.
They're not going to purchase a term policy when you look like me, but they may if you look like you.
Dude, I'm going to live forever.
Oh, that's right.
So if you've got a $200,000 death benefit, and it's a permanent policy, then they're going to look at, what are your monthly premium payments on it? They're going to take over on those for you. Yep. But the bottom line is you're probably going to get a $60,000 one-time payout.
That's right.
That's going to help you pay for care. And then what happens when you die? What does the life settlement company get?
They get the death benefit.
They get the other $140,000. They get the $200,000, and then minus the $60,000 they paid out. They got to, and then minus the premium payments. But they might make, $125,000 that no longer goes to your beneficiaries.
That's right.
Right.
That's right.
So it is a way to get some funds out of it, out of your, to pay for care, but it is a huge cost.
Yes, it absolutely
It's a huge cost to your family.
Especially because when you look at your life insurance, if you've been paying for it for 30 years, like a lot of people do, then you have to sell that. I mean, that could very well be a loss to you.
Well, and one of the things that is always going to happen, if you've got an old whole life policy as an example, and you've been paying into it for 30 years, it might have $30,000 worth of money inside of it.
Yep.
So you could cancel the policy, get that $30,000 out. So a life settlement is going to give you more. They might give you $60,000.
Yeah. If they give you $60,000, you double your money.
You doubled your money. But here's the other thing to consider. There is a taxable consequence for any money you receive above the amount you put in.
Yeah, the return is called return of premiums. Any excess of a return of premium is taxable.
That's right. Not only is it taxable, so let's say you put in $30,000.
Yep.
And they give you 60. Well, 30 grand's a return of premium. 30 grand is excess. Mm-hmm. That also could then screw up your qualifications for other programs or
such as
Medicaid. Or so that's another consequence. The bottom line is life settlements I always look at as a last resort.
Yep. Because
the cost is so big to your beneficiaries, to your family, and it could have some taxable events as well.
Yeah, absolutely.
So, all right. So it's a tool, but I would say use it kind of as a last resort. Now, one other thing that I just want to touch on has to do with family care.
Okay.
Because it's not really a self-pay option because there is no pay, but it's in that category because because your family's kind of paying the price for you.
That's right.
I don't mean paying the price as in the dollars.
No.
I mean they're sacrificing their time. Right, they're giving up their personal lives.
Yep.
They're taking care of you.
Oh yeah.
So we talked a little bit about the statistics last week. We've got about 34 million unpaid caregivers in the U.S. Who are taking care of somebody over the age of 50. Spouses, family, friends, all of those kinds of things. That saved over the last 12 months people who need long-term care $470 billion. So it's humongous. But for those full-time caregivers, they are paying the price.
They are, because you have your freedom.
Yep.
Right? Because now you're tied to the house, and you're tied to doctor's appointments, and you're tied to, oh my gosh, in the middle of the night, there's an accident. Now you're at the hospital. There's a lot of things that go into it. And if you have young kids at home, like my wife and I went through, it can be a big burden. Not that I regret having my mother-in-law in our house for 3 years. I do not regret that at all, but there is a big cost to it.
Well, and you guys were fortunate that, your wife was able to stay home full time, right?
Yep.
In the averages, we got 34 million unpaid caregivers. The average work that is still done outside of the home is about 35 hours per week.
Right. And then you got to also remember there too, if, say like my wife, if she still had to work, let's say she had to work outside the home, then the cost of having a nurse come in and stay in the home for that 8 hours, 6 hours, 10 hours, depending on whatever the workday is. I mean, it can be pretty pricey. You can pay $30, $40 an hour.
Or an adult daycare center.
Yeah.
But those average about $1,800 a month, for just some part-time help during the day. Yeah. The other thing that happens, 70% of unpaid family caregivers, they say that their own finances are negatively impacted.
Sure, they are.
They might not be able to save for their own retirement.
Right.
They might not be able to save for their own kids' college.
Yeah.
So I think having family to help you is a real blessing. What I always encourage my clients to do is have the conversation with your family now.
Yeah.
Not, oh my gosh, I need care and I'm expecting you to do it right this second.
come up with a plan together.
Yeah, absolutely. You should. It's just like anything in life, you plan for your vacations. If you're driving across the country, you make a plan on the route you're going to go to, when you get gas, where you're staying, what you're going to see. Why not do that with every other aspect of your life?
Yeah. I would highly encourage, for anyone who did not watch last week's episode, I got to interview your wife.
Yep.
And it was kind of from her perspective as a caregiver, but also transitioning mom into a home.
Right.
That was a fantastic episode from a family member. And then 3 weeks ago, I had Clarissa, who's another client, and she's a full-time caregiver for her mother-in-law. So some great episodes on kind of the challenges of being a full-time caregiver.
That's right.
So, all right. I think that's it for self-pay. Did I miss anything?
You did not.
Okay. We'll be back next week to talk about the other way to pay for things, which is through some government programs or some insurance programs.
Check forging.
Or we're not going to talk about check forging. So that's not a real way to pay.
Bank robbery?
So we'll be back next week with that. However, between now and then, we would love it if you would share us with a friend. If you got any value out of today's episode, please share whatever podcast app you listen to, share it with them. Go on there, give us a thumbs up, give us some comments.
Share it with your mom and dad.
So, absolutely. And your brothers and sisters, because you might all be splitting the care for mom and dad.
Yep.
So if you got any questions about your own money puzzle, email it to us at questions@yourmoneypuzzle.com. Otherwise, go out and do something to improve your money puzzle. You'll be glad that you did, and we will come back and see you again next week.
Have a great weekend.
Registered representative of and securities offered through Securities Management and Research, Inc., SM&R. Member FINRA SIPC. Investment advisory services offered through BFC Planning, Inc. Edgen Insurance and Financial Services, Johnson Financial Services, SM&R, American National Family of Companies, and BFC Planning are independent entities. There are risks involved with investing which may include market fluctuation and possible loss of principal value. Particular investments may not be suitable for certain situations. Carefully consider the risks and possible consequences involved prior to making an investment decision. Our firm does not provide legal or tax advice. Be sure to consult with your own legal and tax advisors before taking any action that may have tax implications.